Hi there, this is Vasia. I hope you guys are doing well today. In today's quick video, I thought I would cover a question that I've been asking myself lately, and frankly a lot of investors have been raising the same, and namely, what is going on with the really low cash on cash returns that we're seeing on a lot of deals that are currently hitting the market. And in prior quick snippets and videos, we've explained the concepts of loan to value, cap rates, cash on cash return, and other key performance indicators that we monitor. But effectively, there are two things happening. One, the loan to value ratios, or the amount of debt that lenders are providing, has reduced for a number of reasons. So that increases the amount of equity that operators need to bring to the table. And secondly, the operating expenses are increasing, specifically expenses related to debt service due to the higher interest rate environment. And so all of that combined is not only compressing the cash flow on deals, but also when looking at a lower leverage profile deal, which in my opinion is actually lower risk, but it also reduces the overall return. So when you look at it on a risk-adjusted basis, does it make the deal better or worse? Well, on a risk-adjusted basis, to me, it's not necessarily worse because you're entering with less debt. But of course, then in return, you need to raise more capital, and because your overall cash flow is compressed, given the higher interest rate and other factors, and then your cash on cash return number is lower. So investors are used to seeing something closer to 8 to 10%. Now the spectrum has shifted from 6 to 8, with 6 and 7 being more frequently used observations. Now, if you're really focused on cash return, real estate may not be the best option for you right now. You can invest in more liquid investments like the stock market, where you can probably get 7 or 8%. But of course, that comes with a lot more volatility, and you don't get the tax deferral benefits and building wealth over time. If you wanted something a little bit more secure, you could consider the bond market. There are treasuries that are currently paying 5%. And so as long as you hold that bond to maturity, you could minimize some of that market volatility and get that nearly guaranteed return. But of course, you don't get to necessarily build wealth over time or benefit from tax deferral strategies. With real estate, it's less liquid, unlike the stock and bond market. You're currently getting lower returns for the reasons that we explained at the beginning of our video, but you do get the equity build up over time, especially as you start paying down the debt. And you do get the tax deferral benefits, which are huge for building wealth over time. So we hope that addresses the question, and as usual, our videos are not intended to provide tax, legal, or investment advice. They're for educational purposes only, and really our opportunity to share our personal views and experiences. So if you enjoy the content, please like, share, and subscribe, and we'll see you at the next one.